Hey everyone, welcome to today's Explainer. I'm Steve. Look, today we are tossing out the tired old talking points and we're getting right down to the raw power of the tape. For weeks now, the mainstream macro bears have been out there screaming the rising yields and all this geopolitical friction are going to permanently cap this market. But you know what? The actual hard data is completely shattering those expectations. We're reading the raw tape today because the underlying structure of this market is screaming something entirely different.
So let me ask you something, straight up. Are you letting macro ghosts scare you out of a winning tape? Are you just sitting on your hands right now, holding on to cash, waiting for that catastrophic crash the talking heads practically promised you, only to wake up and watch the market grind higher every single day? Man, if you're letting these macro ghosts scare you, you are getting left at the station. Seriously, it is time to stop listening to the fear-mongering and start trading reality. Let's take a look at where the real institutional momentum is actually moving.
Take a look at the actual scoreboard here. This is the unvarnished truth of the market right now. Just notice what's taking a breather and what's absolutely not. Bitcoin took a pretty sharp institutional hit, pulling down to that 70,767 level. Spot gold? Yeah, it's catching a mild breather too, sitting around 4,517. But the S&P 500 futures? The /ES absorbed some minor morning profit-taking and almost immediately found an aggressive floor of buyers, pushing right back up to 7,575.25. That right there, that structural validation for equity buyers is staring us right in the face.
Section 1. The Yield Myth Decoupled.
Here's the thing the bears completely fundamentally misunderstand. Institutional capital? It's aggressively decoupling from the fixed income desk. And why is that? It's simple. Big tech and those mega-cap growth companies are generating so much raw cash flow right now, they literally do not care about higher borrowing costs. They're entirely self-funding. I mean, the yield on a 10-year treasury means absolutely nothing to a tech giant that's pulling in billions in free cash flow every single quarter. It's a completely different ballgame now.
And hey, if you need proof, this isn't just some phantom tech bubble. Look at this number, 62.7. That is today's Chicago PMI print, and it is stellar. This absolutely proves the underlying economy isn't just sitting there stagnant. Corporate America is adjusting, the manufacturing sector is actively accelerating, and the broader economy is in full expansion mode. Stocks are proving to be the ultimate growth engine right now, totally regardless of what the yield environment is doing.
Moving right along, Section 2. Geopolitical hype meets physical reality.
For weeks now, we've watched algorithmic money aggressively pump energy prices based on absolutely nothing but paper hype. The whole fear was this idea of a permanent blockade, right? A massive energy shock that was going to step in and cripple the global economy. But when you contrast that paper fear-mongering with cold, hard physical reality, the story completely flips. Commerce is flowing freely out there, shipping lanes are moving, the supply chains are holding firm. That catastrophic energy shock everyone was braced for, it simply hasn't materialized.
And this chart right here brilliantly illustrates what happens when that paper hype smacks right into physical reality. We're looking at Brent crude, the BZ contract. Just look at the breakdown. The paper premium has leaked entirely out of the market. We've completely broken that upward stance, slicing incredibly clean right below the daily 20 simple moving average and actively failing the 50 exponential moving average. It's tumbling right back down toward that 93.86 mark.
Now, what's the actual real-world takeaway from that crude breakdown? It's actually huge. Falling oil acts like a massive corporate tax cut. Literally. It is a pure tailwind for stocks. This downside expansion in crude just expands corporate margins across the board. And honestly, just as importantly, it gives the Federal Reserve a massive green light to keep policy stable. It is the absolute perfect macroeconomic backdrop for an equity rip higher.
Which brings us to Section 3. Punishing defensive capital.
You don't need to look any further than Warren Buffett's empire for proof of this dynamic. Berkshire Hathaway has actually been slipping backward while the broader index just keeps tracking higher. Why? Because sitting on a massive defensive mountain of cash, just crossing your fingers and waiting for a financial crisis to bail you out, well, that is a severely underperforming strategy when a structural bull market is actively underway.
The market is aggressively, and I mean aggressively, punishing capital that's just sitting on the sidelines. Those institutional funds that hold up in defensive safe havens, they are getting absolutely smoked by the benchmark right now. And now they're being forced to chase performance. We're seeing a massive rotation straight out of cash and directly into high momentum equities, simply because these portfolio managers cannot afford to underperform this kind of tape. Their jobs depend on it.
All right, let's wrap this up with Section 4, Professional Trading Directives.
Take a look at the S&P futures, the -ES. This thing isn't just surviving, it is flat out dominating the tape. We're pinned cleanly above the 20-day simple moving average at 7,550, and the market is using that exact level as a springboard. The entire daily trend is firmly supported by that upward-sloping 50-day EMA down at 7,410. Listen, as long as the -ES stays structurally pinned above these moving averages, the path of least resistance is aggressively higher, period. So here are your rules of engagement for the floor. Number 1, stop fighting the trend. I mean it, your job is not to predict the exact top, your job is to ride the momentum until the charts explicitly tell you otherwise. Number 2, trade the strength that is right in front of you on your screen. The energy breakdown, that's real. The tech cash flow, that is real. And number 3, ignore the macro ghosts. Turn off the noise, tune out the bears, and trust the raw tape.
Look, the structure is clear and the institutional money is already making its move. The bulls are firmly, undeniably in the driver's seat of this engine. So the only question left to ask yourself right now is this: knowing all of that, are you ready for the morning bell? Stay disciplined out there, trust your charts, and let's go attack this tape. Thanks for joining this explainer. I'm Steve. I'll see you in the trenches.